Today we want to talk about solo 401ks. So a solo 401k is also known as an individual 401k. There's a few different names for it, but basically it's a business retirement account. It's a retirement account that you can establish if you have a business. And why is it so important? It's because a lot of times a 401k becomes one of the largest vehicles by which we use to save for retirement. Okay, so who can use a solo 401k? They're usually very complicated to administer, and this is why years ago Congress passed a solo 401k vehicle for the sole owner business owner. Okay, if you own a business by yourself, have no employees, you can establish a solo 401k in a very simple way. You can now. There's one caveat to that. You can also have your spouse participate. You have your spouse as an employee, but it can only be you and a spouse who can participate in a solo 401k. So why would someone want to do this, Jason?
Yeah. Well, for one, you can contribute a significant amount of money into it. So, for example, if you just had a regular IRA, then you would only be able to contribute, a small amount compared to what you contribute into a solo 401k. So you can contribute a significant amount, and so that gives you the ability, as a business owner, to not only save for your retirement, but also to get a massive deduction from taxes. So,
assuming you do the traditional route.
That's right, and that's the other benefit. So you could also have a Roth 401k inside of it. So if you're at an income level where you're no longer eligible to contribute to a Roth IRA, you could have a Roth 401k in your solo, which could give you the ability to now grow tax-free money. So those are some of the benefits.
Right. So now that we know the benefits, again, you could possibly get large tax deduction. You can possibly contribute to a Roth account when you can't as an individual because you're phased out. Okay. Right. So we know that. Here's how they work. Okay. You establish an account for yourself or for you and your spouse. And there's two features to this because a lot of people know that they can get a deduction via historically a small business plan, which is like a SEP, where the company contributes a percentage, right? Or a simple, where it's more payroll deduction driven. Okay, so this kind of brings it all together. Okay, and you have both sides of the fence. So let me start on one side. You can contribute, and as of the date of this recording, which we're in 2023, an employee, again, you have to be on payroll, right? An employee can contribute up to $22,500 a year. Okay, into their retirement account, whether it's the traditional and get a deduction on that, or the Roth feature, and still put that in the account. And if you're over 50, there's a catch-up contribution that you can do an additional $7,500 on top of that. So if you're over 50, you can put up to $30,000 as of the date of this recording, 2023, into this retirement account. That's the employee contribution. It comes out of your paycheck. So obviously you have to make at least that much in W-2 income to be able to then deduct it, right? The other half of this is what's the employee contribution part of it, okay? And that is the employer, which in this case is yourself, okay? But coming from the business can contribute a percentage of your W-2 income up to 25%. It's not mandatory. You don't have to do it, but that's one of the benefits. You can go up that much higher than just a 22.5 or the 30,000. So you can contribute up to 25,000 of your, now understand, it's your W-2 income.
25%, right.
25% of your W-2 income. This is where it gets tricky because I know that a lot of people try to minimize their W-2 income to not pay as much in payroll taxes and take more distributions, K-1s. But the K-1 income doesn't count. Okay, it's only the W-2 income. So now you can have the employee contribution, the employer contribution together, getting a lot more than what you could do if you just had an individual IRA. Now, there is a maximum as of this year. Both of those together cannot exceed $66,000. Or if you're over 50, $73,500.
So the thing that you have to remember, though, like if you increase your salary, you're going to have to pay a little bit more in payroll tax. However, a lot of times the people that are doing this are in a much higher tax bracket. So you make up the difference with the deduction that you get for contributing into the solo 401k.
That's a great point, because as you increase your payroll, your W-2 income, you're going to pay more of those fuda, suda, huda, kudas, right? But that's a lot less typically than your federal tax bracket, which could be the 20s, 30s, potentially, depending on how much income you earn.
That's right. So now that we know who it's for and how it's used, here are some important deadlines that you should know if you're going to set up a solo 401k. So it has to be established before the end of the year, December 31st. Okay. But you have until the first week of January for the employee contribution to be completed. All right.
to be deposited.
Exactly. However, for the employer side, you have until the tax filing deadline for the employer. Solo 401k could be an excellent vehicle for you to be able to save quickly for your retirement, potentially get a large tax deduction if you're a solo business owner.
So we hope this helps, and we hope to see you soon.